Welcome to The Money Manager. I'm Lindsay Williams in Cape Town. In Johannesburg is Dani Fenter, Advisory Partner at Citadel. This is a particularly pertinent money manager because it's all to do with currency and currency valuations. The headline is, what do currency valuations mean to investors? Dani, before we get into the new Nomura Holdings iPhone index versus the Economist Big Mac index and why the two are different, it really is very, very important. Suddenly, when we are all sanguine about the movement of the rand against other major trading partners, suddenly the rand goes on a bit of a trot for reasons that need not detain us. So pertinent.
Exactly, very true. The whole article, the premise of the article is just starting off with the point that holding a US dollar, it can be seen as an asset. And that's what I started exploring. Just like you can value the price of a share, per se, you can also value the price of a currency. And as you mentioned now, the Nomura iPhone index recently launched, which is quite new to the world. I don't know what name it will be given over time, but I'm sure the investment gurus will figure out something nifty. That stated that the US dollar is undervalued in comparison to other currencies, whereas the more popular Big Mac index that so many economists speak of, it says the complete opposite. And yes, that's what I was looking at with establishing the idea.
Yeah, of course. I mean, we don't need to get into the technicalities of the two indexes, but an iPhone is a luxury item, and a Big Mac is something that many people eat, you know, a couple of times a week. So, of course, there's going to be differences. I personally think there should be a beer index. I mean, we don't need to go into that now, but I reckon a beer is probably one in between the two. What do you think?
I think that'll be very close to the true market of what all gents would like to see in their hand and in their wallet. Let's assume it that way.
Okay, so you said about this currency valuation importance for investors. What did you start to conclude?
Well, what I found is, with it, even looking at our client portfolios, a lot of people realize that we have this knee-jerk reaction. The dollar slides, everybody runs to the hills, wants to buy dollars. But when you set up a financial plan or an investment strategy that is goal-orientated, you must realize when you're going to make these acquisitions of foreign currency. When you go offshore, also keep in mind that it is an offshore investment. Don't compare it to a South African market anymore. Keep it in offshore terms. I mean, you're investing in an economy with a different inflation rate. You're investing in an economy with different sectors. And the list carries on. So my advice to my clients is don't keep converting it back to South African rands, because that's when you fall in the trap of trying to react to a certain situation instead of making a long-term investment decision for a portfolio. We generally acquire offshore global equities. Yes, they may be volatile when converting back to rand, but for the benefit of not only economic diversification, maybe now more pertinent political diversification, but to ensure that the long-term fundamentals of portfolio construction are indeed in place within the bigger scheme of the portfolio.
Does it matter if the rand is 17 or 13 when it comes to talking about externalising your portfolio? I mean, the point is that, like it or not, the rand has been a long-term bear market, and the likelihood is, unfortunately, that that might continue. So 17 or 13, obviously it's much better to do it at 13 than 17, but nonetheless you have to diversify, so just do it, maybe in different chunks though.
Yes, it's very true, but then you must come back to behavioral finance of a client. He'll always peg the current movement of the rand dollar and equate that in the discussion that you have over the table. So if you take funds over at 16 rand to the dollar, well, it's a different discussion completely when you start talking to the client when it's back at 12. Now, I'm not saying and I'm not projecting that it's going back to 12, but I think, again, it must be back to a strategy, a plan, a goal. When we do investment portfolios, it's not... If we plan an annual transfer of funds across into USD, then we'll make the decision as and when we get to the point. Just because it's very volatile at this point in time, doesn't mean you have to make a decision. If you planned correctly, you can sit on the capital value, even in South African cash, wait for the right time, and then transfer the funds across. So I think it all depends on what the financial profile of the person is. If he's planning to move abroad, then yes, take the knock and go at 17. But if it's a long-term investment philosophy, maybe not. Just hold on. Wait for maybe the normality to set back into the market. Just wait for it to normalize again. I don't think we're in a normal environment at this point in time in the market.
No, but timing the market is so difficult, and timing the currency market is probably even more difficult than the equity market. We don't know what's going on. I don't think anyone knows what's going on. You can make an educated guess. But the other thing that I think is very important, Dani, and that is don't go offshore because of the rand. Go offshore because of the valuations and the diversification argument.
I can't say it any better than that. Really, really true. And when you do go abroad and you have invested abroad, you must also just be aware that you are generating interest, you are generating dividends, you are generating capital gains in the event of a sale. You have to report that back to SARS when you do your annual tax submissions. A lot of individuals completely forget about that and then do come up with penalties at the time of reporting season.
Yeah. If the rules change, I mean, if there is a complete blanket, what's the word I'm looking for? Relaxation of exchange controls. In other words, portfolio managers, pension funds, individuals, there'll be free movement. Do you think that most people would avail themselves of the increased percentage, or do you think we're just about right at the moment?
My personal opinion on that is, looking at the top 40 on the JSE, it's such diversified global businesses. They're all earning and generating foreign currency. So when you invest in the Naspers, the South African breweries and the likes, you are actually getting a diversified revenue stream, the so-called rand hedges, just speaking back to the currency. Again, Shoprite's got businesses across Africa, so there you are getting global investment opportunities, etc. So I'm quite happy with the way things are standing at this point in time, but it has to touch on, again, back to the strategy, back to the plan. If it's a person that you know 100% can't go abroad, has to stay in South Africa, has to retire here because of family or because of other matters that needs to be identified, then yes, stay in South African market and use the rand hedges for abroad. It all depends on the situation of the client, and that's where a well-qualified financial advisor would be able to assist in establishing your personal investment strategy for the long term, not for the knee-jerk short-term reactions.
There's been so much internationalisation of funds from companies. You talk about Shoprite, and a day after Shoprite came out with their results, along came Woolworths. And 60% is in South Africa, of their profits that is, 40% now in Australia. I mean, this is coming up to rand hedge status.
Yeah, it's very true. Something to keep in mind when establishing a portfolio. So when you buy, and let's go back to the layman's terms, general unit trust and diversify across 3 or 4 unit trusts, sometimes it's quite worth the effort to go and look at the top 10 holdings, calculate the valuations of the 4 or 5 unit trusts you hold to see how much assets you've actually got invested with a Naspers, with a SAB Miller, and aren't you actually just becoming a benchmark hugger? Aren't you actually not diversifying efficiently, or effectively might be the better word. So there's a lot of elements to look at when evaluating and establishing an investment strategy for a client.
Yeah, so what's the message now? Obviously, every single client has different needs, different goals, different means, and different psychological profile when it comes to investing. But in generally speaking, someone comes into your office at Citadel as an advisory partner, you're the advisory partner. What do you say to them? What's the first message that you get across? Is it diversification?
At this point in time, where the global markets are where they are, we see earnings bases coming off, and if you just back to the basics of a share, we know that if earnings translate into the share price, and if earnings are coming off, then be aware of where we're going. So I wouldn't go global equities only. If I had to establish a portfolio, yes, I would diversify effectively. I'd buy all asset classes. I'll include hedge funds. We know that hedge funds are now becoming unitized environment, which is very nice to have in the market because it increases the liquidity of buying and selling that hedge. But yes, we definitely maximizing the number of assets included in the portfolio, including different strategies within the equity component, and that's for the offshore market and for the local market. We know that value investing has been quite a bit of a dog show over the last few years, and ReCM comes to mind, etc. But when you look at the start of the year, if you invested in the start of the year, I've heard 72% is not a bad number to start off on. But again, it's breaking down back to the basics. Understand what you're really getting invested in.
Yeah, it's very interesting indeed, actually, the way that things have changed since the end of January. I mean, it's been I mean, as you say, the value investors and value portfolio managers were the pariahs of the industry. They weren't getting many dinner party invitations, Dani, but now they're flavour of the month. Things can change. What about value versus growth, and what about active versus passive? Where do you stand on those two?
My personal preference, I like both. I like the core and satellite approach. So in a lot of my clients' portfolios that I'm giving out at the moment, I do include passive solutions. I'm making use of the S&P 500 index, either through iShare or Vanguard. I'm making use of just to give some flavor or flair, if clients do require it, is the best word there, for their portfolio, include maybe the mid-cap index of the US. I do also include All World from Vanguard and iShare similarly. And then we do give the fighter pilots a chance as well. I mean, that's where active comes to the fore. We know when the markets are as concentrated as they are now, you need diversity. You need a person putting his mind, his specialities, his field to the portfolio. And that's why I definitely strongly suggest that, given where we are in the global economy now, active, I'm of the opinion, will definitely outperform going ahead for the medium to long term now.
Especially as we have been going sideways on the JSE. A bull market is one thing, and that's where passive does well. But when a market goes sideways or starts to go down, then active comes to the fore. That's when you lot really start to earn your monthly envelope. Finally, asset allocation. How important is that to you rather than stock picking? I know they're both important, but is asset allocation the key to success?
Yes, I think asset allocation is the driver of a good, sound investment strategy, and each asset class has got its own volatility, it's got its own assumptions, it's got its own criteria, what drives it. The long and the short is you have to understand the elements, firstly, and how they are and why they are included in the portfolio.
Dani, thanks very much for popping in this evening. That's Dani Fenter, advisory partner at Citadel, and that's it for The Money Manager.